The title trap: how your deed decides who gets your house. Your deed is not just paper. It's a lane marker for recovery and for who actually gets the home. Let's make each choice plain and show how it plays with recovery rules. Start with sole owner. One person on title, full control. Clean while you're living there. But at death, the home goes through probate unless you used a deed or trust that skips court. In probate-only states, that probate step is the on-ramp for Medicaid recovery. If no bypass is set, the state can file its claim. In expanded recovery states, even if you try to avoid probate later, other moves can still be reached. Sole owner with no bypass is the riskiest lane. Joint tenancy with right of survivorship looks safer. Two owners. When one dies, the survivor gets full title automatically outside probate. In probate-only states, that can block a claim at the first death because there's no probate estate. But here's where most people mess up. In expanded recovery states, recovery may still reach non-probate transfers. And when the last owner dies, if nothing more is set, probate reappears. Also, adding a child as a joint owner can blow up taxes and invite their creditors onto your deed. We'll come back to that mistake. Tenants in common splits ownership into shares. Each owner's share goes to their estate at death. That means probate for that share unless there's a specific bypass. For recovery, tenants in common often hands the state an easy lane because probate is built in. Unless every share is planned to avoid probate, expect exposure. Life estate deeds divide now and later. A traditional life estate without powers gives you the right to live there, but you cannot sell or refinance without the remainder persons. At death, the property passes outside probate to the remainder persons. That can block recovery in probate-only states. But there are two big downsides: lost control while alive and tax traps if you add kids early. Also, in some expanded states, recovery can still assert a claim, and lifetime transfers can trigger look-back penalties if inside 5 years. Enhanced life estate deeds, ladybird deeds, change the picture where allowed. Florida, Texas, Michigan, Vermont, and West Virginia. You keep full control. You can sell, mortgage, or change beneficiaries without the remainder's consent. On death, the house passes outside probate. In probate-only states, that shuts the door on recovery against the home because there's no probate asset. In those 5 states, this is a strong tool to hold control now and avoid a claim later. Outside those states, do not assume an enhanced form exists. Many places do not honor it. Transfer on death deeds are simple forms that move the home at death without probate. In probate-only states, a TOD deed can work like a bypass and can help avoid a claim on the house. In expanded recovery states, TOD is not a force field. Laws in those states can reach non-probate transfers, which means the state may still file against the beneficiary or the property. Easy form, hidden trap. What about trusts? A revocable living trust is great for probate avoidance and for clean transfers across family lines. But for Medicaid recovery, it usually does not protect the house because assets are still yours. An irrevocable trust done early, well outside the 5-year Medicaid look-back, can help in some states, but it trades control for protection. Funding late or with the wrong terms can cause penalties or keep the home countable. In expanded recovery states, certain non-probate paths are still exposed, so trust design and timing must match your state's rules. Homestead status helps with taxes and gives some equity shielding from general creditors in some states. It is not a force field against Medicaid estate recovery. Do not rely on homestead alone. It won't stop the ledger from turning into a claim later. Check your state's homestead and recovery statutes side by side. Now, the biggest blunder I see, adding an adult child to the deed to be safe. It sounds neat and fast. It isn't. First, you lose a full step up in tax basis on that portion at your death, which can cause large capital gains if they sell. Second, you invite your child's risks onto your title, divorce, lawsuits, debts. Third, for Medicaid, that transfer can be a gift. If it happens inside the 5-year look-back, you can trigger a penalty period when you most need help. And in expanded recovery states, even that joint setup may not stop a later claim. High risk, low reward. So, how do you pick a lane? Map your state's recovery rules first. If you're in Florida, Texas, Michigan, Vermont, or West Virginia, a ladybird deed can keep control and avoid probate, often blocking a claim on the house. If your state is probate only and does not allow ladybird, a TOD deed, or a well-coordinated trust plus beneficiary setup can work. If you're in an expanded recovery state, you likely need a deeper plan. Strong POA, timed irrevocable trust if appropriate, and careful spend down plus beneficiary alignment. Title is step 1. The program and timing decide the rest. Here's the test I give families. Lie. If it skips probate, it's protected. Truth. It must skip probate and withstand your state's recovery rules. If yes, you're on track. If not, fix title before any waiver hour starts. Because once that ledger opens, the state is waiting at the end. Now, with title clear, let's set up your beneficiaries so the rest of your assets don't fall back into probate. Beneficiary designations that bypass the clawback. Once title is set, you have to close the other on-ramps to probate. Lie. Only the house matters. Trap. One orphan account labeled estate can open probate and invite recovery. So our job is simple. Keep assets out of probate in legal ways your state allows, while staying clear of look-back traps. This is where beneficiary designations do heavy lifting. Start with bank and brokerage accounts. Use POD, payable on death, and TOD, transfer on death, to name who gets the funds. That means when you pass, the bank pays the named person directly. No probate, no court delay. In probate-only recovery states, this often shuts the door on a claim for those accounts because there's no estate asset to file against. In expanded recovery states, the state may still reach certain non-probate transfers. So we coordinate designations with your state's rules and your care program choices. Retirement accounts already use beneficiaries. Check them now. Name primary and backups. Use per stirpes if you want a grandchild to take a deceased child's share. Keep the tax angle clean by matching beneficiary types to the account rules. For IRAs, avoid naming the estate. That drags the account into probate, which invites a claim and can limit stretch options for heirs. Life insurance is next. Policies with named beneficiaries pass outside probate. That's good, but make sure the owner and beneficiary structure fits your plan. If the estate is the beneficiary, you lose the bypass and add claim risk. Fix that. Also confirm that premium payments are current and that the carrier has the right address and SSN for each beneficiary. Tiny admin misses send checks to limbo. For regular investment accounts, use TOD where offered. Some custodians call it transfer on death or beneficiary transfer. Same idea. Again, in probate-only states, this helps keep assets out of reach. In expanded recovery states, TOD may still be exposed if the state targets non-probate transfers. That's why we never rely on labels alone. We match the form to the statute where you live. Now, trusts. A revocable living trust is a great probate bypass tool for many assets. You title the account to the trust or add the trust as the TOD/POD beneficiary. On death, the trust instructions control the handoff without court. But remember, revocable trusts do not shield assets from Medicaid recovery by themselves because you still control them. The value here is clean transfer and court avoidance. In probate-only states, that can be enough to stop a claim. In expanded states, the law may allow claims against trust distributions or the trustee, so design and timing matter. What about irrevocable trusts? These can add protection if created and funded outside Medicaid's 5-year look-back and drafted to fit your state's rules. They trade control for safety. This is not a DIY move. If you need care soon, funding an irrevocable trust late can cause a penalty. If done early and correctly, it can move assets, including a home in some states, off the target path. Your POA must have express powers to create and fund trusts, or your agent can't do it for you if you're not able. Here's where forms fail. Generic POAs often cap gifting to customary amounts or past giving patterns. That blocks strategic moves. Your POA needs explicit authority to make gifts, including to the agent if your spouse is the agent, to create and fund trusts, to change or add beneficiary designations where allowed, to retitle accounts, to handle tax filings, and to manage real estate. In states like New York, that may include a separate statutory gifts rider. Without this detail, banks and custodians can say no right when timing matters most. Coordination is everything. If your deed passes the house outside probate, but one bank account still lists estate as beneficiary, that one orphan account can open probate. Once probate opens, recovery can jump in. So we map every asset: home, bank, brokerage, IRA, life insurance, annuities, vehicles, even prepaid burial accounts. Each gets a lane: deed, trust, title, pod/TOD, or beneficiary form. Then we verify backups. If a child predeceases you, does their share flow to their kids, or does it collapse to the other siblings? Decide now. Let's ground this with a quick case. Harold and June had a house, 2 IRAs, a joint bank account, and a small brokerage in Harold's name. They fixed the deed in Texas with a Lady Bird deed. Great start. Their IRAs had each other as primary, kids as backups. Clean. But the solo brokerage still flowed to estate. When Harold passed, that one account opened probate. The state filed a claim for June's HCBS ledger because recovery in their state runs through probate. The kids had to settle the claim before closing the estate, even though most assets were set. One form, big delay. Now flip it. Same assets, but the brokerage adds TOD to the trust. The joint bank account adds POD to the trust. The trust names kids per stirpes. On Harold's death, nothing hits probate. When June later passes, the house moves by Lady Bird deed. Accounts flow by trust and TOD/POD, and there is no estate to file against. In a probate-only state, that shuts the door. In an expanded state, we'd add program choices that avoid recovery or earlier trust design outside look-back. 2 last points. First, align titles with your care plan timing. Before any Medicaid waiver hour, finish your beneficiary sweep. Second, review yearly. Mergers, closed accounts, lost riders, and family changes break setups. A 20-minute annual check keeps you out of probate by accident. Get a 1-page map in the front of your file with every account, its lane, and the latest statement date. Simple, boring, the program
Safe.
line. That's how you
Medicaid
bypass
versus
the waivers versus VA aid and attendance. Now we choose lanes. 3 programs shape the path: Medicaid long-term care, Medicaid HCBS waivers, and VA aid and attendance. Lie. All help dollars are the same. Trap. Medicaid waivers can create a recovery ledger at 55 plus. VA pensions do not. Get this right, and you buy clean dollars and time. Medicaid long-term care covers nursing homes and, in many states, in-home help through waivers. The trigger that matters for estate recovery is age 55 and receipt of HCBS or institutional services. If you're 55 plus and get waiver hours, your state starts a ledger. Later, they try to collect. In probate-only states, they file against probate assets. In about 24 expanded recovery states, they can reach some non-probate paths too. That's why title and beneficiary work must happen before any waiver hour starts. HCBS waivers are the quiet trap because they look small. A few 8 hours, some adult day health, maybe transportation. Helpful? Yes. But if any of it is paid under a Medicaid waiver after 55, it lands on the ledger in expanded recovery states that can put even a transfer on death deed or some trust pathways in reach at death. Waivers are great when used with the right paper. They are risky when used first with no setup. VA aid and attendance is different. It's a needs-based pension for wartime veterans and surviving spouses. It helps pay for care at home, in assisted living, or in a facility. 2 key points make VA a strong first dollar. The look-back is 3 years, not 5, and there is no estate recovery on VA pensions. That means if you qualify, VA funds do not create a clawback later. Clean money. But the VA will still review transfers in the 36 months before you apply and can impose a penalty period capped by VA rules if you moved assets to qualify. You can often cure a VA penalty by reversing the transfer within 60 days of the decision. Timing and records still matter. So why not always start with VA? 2 reasons. First, not everyone served during a qualifying wartime period or meets the medical need. Second, even if VA fits, you must coordinate with Medicaid so the VA income and unreimbursed medical expenses stack correctly. Done well, VA can reduce your private spend and delay or limit Medicaid waiver use. That buys you time to lock deeds, fix beneficiaries, and complete safe spend downs like roof, ramps, rails, HVAC, dental, vision, and hearing. Let's draw the look-back lines on one page. Medicaid has a 5-year look-back for long-term care eligibility. Any gift or below-market transfer in those 60 months can trigger a penalty. The penalty is a time period you must private pay before benefits start. VA has a 3-year look-back starting from your application date. Transfers inside 36 months can trigger a penalty, but you have a short window to undo them after the VA decides. Different clocks, different cures. Your plan should use the shorter VA clock first, when possible, then step carefully into Medicaid only after your paper and spending order are clean. Here's the $1,000 per month mistake. Families skip VA and pay an extra $1,000 a month out of pocket for 10 years. That's $120,000 gone, often the exact amount they hope to leave the kids. In many cases, a VA pension could have covered that gap with no estate recovery risk. Missing VA is common because people think VA is only for service-connected disability or the forms are too hard. It's a pension for wartime service with financial and medical tests. Learn it, use it, or get help filing through VA-accredited representatives. Mixed coverage is where traps hide. Say you're getting VA aid and attendance, and then accept 1 hour a week of Medicaid waiver help. That 1 hour can open the estate recovery door in an expanded state. Your VA funds remain clean, but the Medicaid waiver hours start a ledger. If your title and beneficiaries aren't ready, you've turned on the claim path. The fix is sequence. Finish deeds, beneficiaries, and safe spend downs first. Use VA to bridge. Bring in Medicaid waiver. Help only after the paper is right, and only if your state's recovery lane is mapped. 2 more timing notes. In some places, community Medicaid look-back rules for in-home care are being phased in or delayed. Don't bank on delays. Plan as if the 5-year rule applies. Also, for married couples, Medicaid's rules allow a community spouse resource allowance. That means you can often keep more assets for the healthy spouse while qualifying the spouse who needs care. But you still need a POA with gifting and trust powers to shift assets fast and clean. Generic forms block the moves. Let's anchor this with a quick path you can copy. Step 1. Check Virginia eligibility. If service dates and medical need fit, prepare a clean application with a care plan and unreimbursed medical expenses documented. Step 2. While VA is pending, update POA with explicit gifting authority, trust creation, and funding real. Estate powers and beneficiary change powers where allowed. Add HIPAA releases. Step 3. Map your state's recovery lane. If you're in Florida, Texas, Michigan, Vermont, or West Virginia, record a Lady Bird deed before any waiver services. If not, use TOD or Trust Plus beneficiaries as your bypass in probate-only states, or consider early irrevocable trust planning if you are in an expanded state and have the time window. Step 4. Finish safe spend downs with receipts. Then, only then, evaluate Medicaid waivers. That's the program line. Use VA first when you can for clean dollars, respect the 5-year Medicaid clock, and never start a waiver hour until your paper and spending order are locked. Now we move to the spend order that keeps the house safe.